Hi guys, so this is going to be a pretty quick to the point video on how exactly to read liquidity. I'm going to assume majority of you already have an idea of how to read liquidity. It's really not that hard. It's actually very, very simple. So we have this model right here, and this is the model that I pretty much trade majority of the time. This is exactly what all of my winners look like majority of the time. Now there is some little tweaks as we go more in depth on how to look for fake break of structures and fake trend lines and things like that more into the course. But this is just a basic overview of what liquidity and how liquidity moves within the market and how to exactly read it. So just looking at this simple model here, and it could be it's a bullish model, but it's the same exact model for a bearish trend. So we see that price had made a higher high, higher low, higher high, higher low, another higher high. And before we create a higher high here to break this high, price didn't in fact test this previous higher low. It actually broke that previous higher low, and we tapped into a point of interest below that, and we went ahead and continued breaking highs. So this right here is very important because how to read liquidity is in the market, pretty much everything is liquidity, right? Like we were talking about in the very first video, that liquidity is all the orders and transactions in the market between buyers and sellers. And that's essentially every single candlestick. Every single candlestick has liquidity, it has volume, no matter what time frame you're on. So we are on the hour time frame right now, and I'll get into the charts in a little bit. But one thing I want you to notice with this model here is we notice that this model, a bullish model, we have a swing high here, a swing high here, and a swing high here, right? All of these highs are protected because we are bullish. Now, what I mean by protected is all of these highs have yet to be invalidated in order to market shift to a bearish market, right? So they're still valid, they're still strong, we're still respecting and breaking highs, right? So right here is where it gets kind of tricky. And like I said, we'll kind of go more into depth. I don't want to throw too much right now because we're just trying to understand how to read liquidity. Um, so how to read liquidity, we have to remember that within this bullish trend, as price is continuing to break highs to go bullish, what does price create every time we break a high, right? It creates a low. So we have this higher low here, and we have this higher low here, and we also have this higher low here. But the difference between this higher low and this higher low is the fact that this swing low had broken, right? The reason why this happens in the market, and you can go ahead and back test it yourself on any time frame, you will notice that as we are in a trending market, bullish or bearish, there is some areas where price will not respect, it will not respect a higher low or a lower high, and it'll just run through it before we continue breaking in that direction that price has to go in. And the reason why we end up breaking a swing low or a swing high is purely because of liquidity. Normally, when we see this model in the market in real time, something that usually sits in this area right here after we had just made that high. Normally, there is going to be built up engineered liquidity created by hedge funds, banks, the bigger players in the game. There's going to be some sort of liquidity resting below this, and banks want to take that out. And that's another reason why we're going to kind of go over market structure in a more advanced way, is because of these fake breaks of structure. So we see that there was some sort of market shift right here when price had fell bearish, breaking this higher low. Now, majority of people would have seen this move and think, oh my God, we have an M pattern, right? We have an M pattern, or this could have stemmed this point from maybe like a supply and demand on a higher time frame, right? But nonetheless, people who trade patterns are seeing this M pattern here, right? And then we have a huge break of structure breaking this, you know, swing low. And so whenever people see this type of break and we automatically break a swing low, we have people coming in here like, okay, the market's going to sell. So what they're doing is they're waiting for price to actually come back up here, have a retest, and then we have, people with their orders up here for probably sell limits, right? And before price had broken bearish, we have people that already have sell stops in the market, right? Depending on the type of trader you are, there's many, many different traders out there. But just know that there's a bunch of orders in the market, a lot of pending orders, a lot of limits, a lot of buy stops, sell stops within the markets. And they're literally below every single swing high and every single swing low. So you have to keep that in mind. No matter what time frame you are on, there will always be liquidity under a swing low or a swing high with every market movement and with any trading range that you're in on any time frame. So when price had broken this swing low here, we are not 100% invalidated for a bullish run just yet, because we want to wait to see how price reacts to an area here. And remember, I was talking about it in our first video. It can literally be anything. So for example, let's say that price had hit maybe a supply and demand area that happened to land somewhere in here, right? And like I said, you don't have to call it a supply and demand area. You can call it whatever you want. I mean, let's just call it a POI for now, because I don't want everybody to be confused based on whatever concepts you use. So let's call it a POI, right? Just a point of interest where we're looking for reactions within the market. So this bullish trend has not yet been invalidated, because although we did break this swing low right here, price still has to come down to this swing low, right? So we want to see how price reacts to this. And usually when I do trade this model, and like I said, you can back test it. But usually when I do trade this model, I do find a very high win rate with trading this model. It's just all about patience. You have to understand the type of liquidity that's being presented right here. And I'll show you different examples of that. But regardless of the fact, there will be some sort of built up liquidity right under this low, which is why price would break to the downside, taking out all these orders and transactions within the market. And from there, like I said, let's have a little patience, and we're going to see how price actually reacts to this POI right here. And from there, we can see if price action gives us a good reaction, a nice bullish engulfing candle, or some type of candle pattern that we can go ahead and have enough confirmations, especially if it breaks structure on the lower time frames, which we'll go over on looking for confirmations on the lower time frames to get in a lot earlier than waiting for like a break of structure to happen on the higher time frames. But for now, we're just looking at this general model of how liquidity works and how to read it within the market. So like I said, we're waiting for liquidity to be taken out right here. And also, back to the foundations of liquidity, we also remember that the entry will be just below liquidity, like I said, and just above it. So if there is built up engineered liquidity below a swing low, what happens when price comes down to take that liquidity out? Whatever your POI is, it's going to, and we have some sort of reaction to that POI, then we can almost assume that this will be a good area to get in for continued buys or continued sells, depending on what the direction of the trend is. So this is exactly how you would read liquidity. We always want to look at something under swing lows and under swing highs. And another thing is, keep in mind, not just this model, but another thing I want you guys to kind of look at is, so when we're also looking at this model here, we're on the 1 hour. So let's say for the sake of this example, we're going to stay on the higher time frames. So we're on the higher time frames here. And keep in mind that when you're on the higher time frames, there's structure within higher time frames, right? That's exactly how the market works. Like I said, the market is fractal. So there's structure within structure, right? And I think that's where everybody gets very confused when it comes to dropping down to the lower time frames and not understanding where we are in the market. But the truth of the matter is really good scalping actually stems from the higher time frames. So although I scalp and I don't go for much pips or for much points, I really just go based off of structure. But I can say that a lot of my precise entries have come from higher time frames. And what I mean when I say that is we have to build a narrative coming from the higher time frame, and then we can break it down as we're going down to the 1 minute time frame for entries. Or if you're not comfortable with the 1 minute, you can definitely find really good entries on the 5 minute. But it has to stem from a higher time frame. That is something that I had to come to terms with when I first started this and learning from trial and error. Is I thought that I could just be on, one time frame and on the 1 minute and catch these insane moves and insane RRs. And it may work some of the time, but in my opinion, you won't have that same consistency that you will starting and stemming from the higher time frames and then breaking it down to the lower time frames. So I think having that narrative and building it down from that is going to help with your accuracy, it's going to help with your consistency, and it's going to help overall with your psychology. So you're not getting lost on the charts, because I look at literally one or two things on the higher time frames, and that already gives me the bias and my direction on what I'm looking for in the lower time frames. So as I was saying, like we're on the 1 hour, right? So we have a 1 hour structure here. And so also keep in mind that as we're pushing bullish or bearish within the market, what is price doing in between these moves? Like I said, there's structure within structure. So as we're breaking highs here to continue bullish, we have little movement like this within the structure, right? Sorry, excuse this is fucking ugly, but just bear with me. So we have, movement like this on the lower time frame going on within our higher time frame structure, right? We have all these little ranges on the 5 minute, on the 15 minute, on the 1 minute, on the 3 minute, 30 minute. Okay, that was ugly as fuck. Okay, I don't know what the fuck happened. Sorry. Anyways, you get the picture. So we're creating higher highs and all that on the lower time frame within a higher time frame structure. So when we're looking at this and we're dissecting it, we can actually kind of zoom in, and we see that because we have these lower time frame structures within this overall 1 hour structure, we can see that, okay, it's creating swing lows, right? It's creating swing lows. And what did I say was beneath every swing low and above every swing high? There's liquidity. There's liquidity under every single swing low and above every single swing high. So that's where people have their orders, they have their limits pending, whatever you want to call it, pending sell stop, buy stops. This is all liquidity. No matter what time frame you are, there's liquidity within that structure. So that's what we have to remember. And that's exactly why on the 1 hour, when we're seeing this, price will continue to break highs, it will drop, because there is some sort of built up engineered liquidity right here on the lower time frame. It comes down to take that liquidity out. And if we are in fact bullish, if we are true to the trend, it will have a nice reaction at a POI and continue breaking the previous high. Okay, so let's see if we can kind of see if I can find something on the charts. Whoops. If we can find something on the chart real quick. Okay. Let's see. Okay. Okay, so this, for example. So we have We have a high here, right? Okay, we have a high there. We have our lows here. Actually, hold on. Might be better to just use the trend line because we have liquidity there. So we have a high there, and then we created lows here, and then you see what had happened was we see a bunch of these wicks. Oh, and that's one thing that I do want to mention as well. So when you see a bunch of wicks, or you even see huge wicks, like seeing huge wicks like this, especially on the higher time frame, and seeing a bunch of the smaller wicks just in one area of a consolidate, basically a consolidation area. You see a consolidation area like this moving side to side, or you see huge wicks like this, especially on the higher time frame, that is definitely liquidity, 100%. Any huge wicks will get filled. So definitely I look out for a lot of wick fills on the higher time frame. That's a great indication on whether price would continue in that direction for a bias. So we have wick fills, and then we had this area where it was a little bit of a consolidation here, probably on a lower time frame. And then price had broken out of that range, took that out, and then we continued up. But this is what I wanted to show you guys. So we have our high, we have our low, we have a high here, and we have a low here, right? This high did not break the previous high, right? So that already tells us that our bias is bearish at the moment. But what happened was instead of price respecting this high right here, what did price do? Because like I was saying, this area right here that we need to pay attention to was probably a consolidation on a lower time frame. And so what happened was price decided to push up after creating a new low, of course. Price decided to push up. And this is where many people in the market probably thought that we were going to start having a market shift here and continue bullish. But in fact, it was actually a draw on liquidity. We wanted to take out all these highs right here because it was a mini consolidation, probably in a lower time frame. So price had taken out all these highs. Sorry. I fucking hate this. Like, I'm always struggling to make the trend line like straight. I freaking hate it. But anyway, so price came up and we took out these highs right here, the area of consolidation. We tapped into a POY, whatever you may call it. We tapped into this POY here. So I'm just gonna vaguely draw a rectangle over it, however you guys want to call it. We tapped into this, right? We tapped into somewhere over here, and what had happened is we continued to break structure here. So this was similar to the model in a sense of we are continuing, we have a trend, right? We have a trend. We know that we're bearish. And what does price do? Price creates some sort of built up engineered liquidity, creates a low, and then price then breaks in the opposite direction, breaking a swing high or swing low just to take out that engineered liquidity, which is a drawn liquidity. And what happens? It taps into a POI. And remember, like I said, I'm always going to be bringing this up because it's very important and you guys need to remember it in your trading. Price is just entry is going to be just above liquidity and just below liquidity. Now, like what happened here? This was liquidity and price tapped just above liquidity. So honestly, if you if you're comfortable with doing market execution, that's 100% fine. Honestly, I find myself doing a lot more buy and sell limits these days. So if you are a trader that does place buy limits, a buy and sell limit, you could have even, you honestly, and this is what I do a lot too. You may catch some drawdown, depending on where exactly the liquidity is and compared to a POY that you're looking at. But I personally don't mind the drawdown, especially if it's on the 1 minute or something where it's in my range of how much I'm actually willing to lose, or like, your stop loss. You can actually place a limit literally. So this is where liquidity ends, right? And this is how we know liquidity ends as well, is because there's no wicks, right? Like there's in this area, like there is no swing high or swing low within this on the lower time frames. This is where liquidity had ended. So when we see liquidity got ended, you actually could have placed, if you wanted to, a sell limit right where liquidity ended, and you could have had your stops at the previous high here. And like I said, this is on the higher time frame. This is the 1 hour, and you could definitely do this on the lower time frame, but this is just an example. So you could have your stop loss at the previous high, or if you want to drop down and have a tighter stop loss, you could probably have it somewhere here, or even at the ending of your POI, depending on what POI you're looking at. If you're looking at this as a supply and demand area, if you're looking at it as an order block area or an area of an imbalance, whatever you want to look at it as, you can have your stop there, okay? But what I'm trying to point out is as soon as liquidity gets taken out, place that shit. Like I place that all the time. And like I said, you may be in some drawdown, but if you're okay with holding that, depending on what time frame you're on, it's 100% okay. So we see that price had tapped the POI, and what happened? We continued to break lows. It ended up breaking this previous low here, and then that's where you would TP. So TPs would always be at, your previous low. But we'll get more into that, like I said, more into depth when we're kind of putting everything together. But this is how to read liquidity. You want to understand that all liquidity is orders in the market, and we understand that orders are going to be within, it's basically going to be structure within structure. There's always going to be orders between or within swing high and swing lows, but pay very close attention to the wicks within the market, to the consolidations in the market. Let's find another one before we move on to our next video. Let's actually find one on the lower time frame. Maybe the 15-minute. I want to find one that's like really clear and easy to kind of follow, because I know that price can get pretty choppy. And that's the good thing too about this strategy, is like you don't really need to wait on your hands to find a position. Honestly, whenever I open my charts, I can pretty much find a setup within like the first 15 minutes of me actually just glimpsing at the chart. If I don't see anything of interest to me within the first 15 minutes, I usually just will put my charts away, and then I'll probably look back at it later. You don't want to force anything if you don't see anything right off the bat. But okay, so this one's a good one. Okay, so we have our high here. We'll use a circle for this one because this one just looks a little bit more clear. Okay, so we have our high here, right? We have our low here. And we obviously know that we're bearish in this trend, okay? Even though we can kind of see what's happening on this side, okay, we know we're bearish, okay? So we see that price had created this low, and then price had came up, and then what happened here? All of this consolidation, right? So this probably on the lower time frame, like I said. Actually, let's drop down to a lower time frame and see just what it's looking like. That should be far enough. Second. Oh, okay, wait. Okay, yeah, that should be good. Okay, I thought I went too far. Okay, so, right. So, okay. So we see on the lower time frame, there was in fact an area of consolidation, built up liquidity right in this area, right? And what did price do? Price was kind of ranging here, and then price, and because we know we're bearish, like I said, we have our direction set. We know we're bearish. And what happened here? Liquidity ends right here, right? Right at this high. And we look to the left and we see that there's a point of interest right here, right? So we can go ahead and mark our point of interest. Like I said, whatever that may be for you, whatever you want to call it. But a point of interest would, let's just measure, let's say from this top to these wicks down here. Okay. And what happened? After price had made a low, it came up with strong momentum. We just took out liquidity right here. We hit a point of interest, and what did price do? It tapped it and it just flew. And we broke previous low to continue bearish. It looks a lot more clear on the 15-minute time frame. But on the 5-minute, I just wanted to show you guys that there was built up liquidity before that drop happened. So, like I said, what did I say earlier? Right after liquidity gets taken out, set a limit. And I promise you, you will get tapped in every single time. Okay, maybe not every single time. Obviously, you want your confirmations, but it's a good way to get a sniper entry. Limits are really good for sniper entries, even if it's on the 1 minute, but like I said, if you feel a lot more comfortable with market execution, that is 100% fine. But yep, we see here after liquidity had been taken out, we tapped into a point of interest, which was this area right here. And then price ended up breaking lows and ultimately broke this previous low right here. So everything is very simple when it comes to reading liquidity. This is definitely not hard at all. If you ever feel confusion on how to read liquidity, refer back to this video, go over it 100 times if you need to. If you need to reach out to me, I am here to help and explain how to read liquidity, but this is just in general on how to read it. And we will continue to have different moving parts and putting it all together. But this is how we read liquidity in the market and understanding it from that model that I had shown you guys in the beginning. So we will move on to our next lesson.